Good afternoon, and welcome to session 3. I'm Jeremy Everett from Yuichon, a tax partner at Yuichon. I've been here in Korea practicing tax for the past 25 years. And I've been asked to moderate this session, which is during which we'll discuss recent transfer pricing rules and implications of COVID-19 and other such exciting matters. To start out, I'd like to turn your attention to our first slide, which while not a technical slide, I think is all the more applicable here in the pandemic as we don masks and worry about vaccines and safe distances, and as all of those things complicate our personal lives, while at the same time we have extreme volatility and also supply chain disruptions which affect comparability and at the same time the arm's length principle as a whole. And those are the things that we're going to address today. We've got a distinguished group of panelists today with over 80 years of combined transfer pricing experience, and I'd like to take a few moments to introduce them before we begin asking them all manner of difficult questions. So to start out, and in no particular order, I don't think they're, well, maybe I'll rearrange things so that they're in the order that they're sitting right now to make things less confusing. So first of all, Jin-oog Suh, or Commissioner Suh, is a senior advisor at Chang, and maybe you could raise your hand just so that we could all identify you. I think we all know anyhow, but he specializes in international tax and transfer pricing matters. After retiring from the NTS in 2017 as commissioner of the Busan Regional Tax Office, he's authored several publications on international taxation, including a study on the application of the profit split method according to the OECD transfer pricing guidelines. And again, his experience from 2020 to the present time at Chang. Before that, he was at the National Tax Service from 1992 to 2007, where he held all sorts of different positions, including Commissioner, as mentioned before, of the Busan Regional Tax Office, also the Daegu Regional Tax Office, Assistant Commissioner of the International Taxation Bureau, also Director of the International Cooperation Office of the International Taxation Bureau. And then he was dispatched both to New York and Los Angeles to the Consulate General of Korea for those cities as tax consul. So he's held many positions, and those are just a few. So welcome, Commissioner Suh. And next, to your right, his immediate left, is Taijoon Kim. One further down, I'm sorry. Confused you. Taijoon Kim at the end is a transfer pricing partner in the Global Transfer Pricing Group at KPMG. He has over 17 years of experience providing professional transfer pricing assistance to multinational corporations in a wide variety of industries. Prior to joining KPMG Korea, Taijoon worked at PwC and Deloitte as a transfer pricing specialist. And then coming back this way, Hyoung Kim is a CPA working at Yoon and Yang in their tax practice group. He's licensed in Maine and focuses his time on transfer pricing and international tax, including mutual agreement procedures, advanced pricing arrangements, tax audit support, tax due diligence, and tax appeals. Hyoung has more than 11 years of international tax experience, including time spent at the Global Transfer Pricing Services Group at KPMG Samjung. And then last, our mystery panelist, who has not yet arrived, but we understand that he's facing some difficulties at the immigration office that hopefully will be well solved in time for him to rush here to answer his very tough questions. And if not, I think our other panelists are shaking in their shoes to have to step in his place and answer those questions. No, they're well prepared. And our last panelist is Ronald Parks. He'll soon be starting position at Lee & Co. here in Korea. He's a former director at a Big Four accounting firm. He's former head of transfer pricing, again at a Big Four accounting firm. He's spent substantial time here in Korea practicing Korean tax as well, with over 20 years experience in international taxation. He's worked in Korea, Vietnam, Central Asia, and the United States. So those are our panelists. We're excited to hear from them. And we have 10 very difficult questions, easy for them maybe, difficult for the rest of us, that they'll answer. And to lead that off, I'd just like to say that Well, maybe we'll change the slide to be a little less distracting. The OECD has published its long-awaited guidelines on transfer pricing implications of the COVID-19 pandemic just before Christmas. Now, the pandemic certainly hasn't gone away since then, and today we'll examine these guidelines and their specific applicability to Korea, or in Korea. But before doing so, we'd first like to use the prior session as a little bit of a segue to briefly discuss tax audit and appeal trends, not in general, but specific with reference to transfer pricing. And then after that, we'll get into the OECD, the new OECD guidelines. So first up, I'd like to address this to Taijoon Kim. And the question is, what are some TP audit trends you're seeing in the era of the COVID-19 pandemic?
Thank you, Jeremy. I will just talk about the recent trends in the era of COVID-19 pandemic about the transfer pricing audit. As you understand, Korea's National Tax Service has been more aggressive in conducting TP audit investigations for foreign invested firms. I believe the reasons are twofold. The first one is a dramatic increase in government spending. As you understand, the COVID-19 pandemic is still ongoing, and the Korean government has been maintaining aggressive fiscal spending to deal with the economic fallout from the pandemic. So at this point, the government still needs more tax revenue. So this is one of the main reasons on why NTS has been very aggressive recently. And the second thing is the NTS also has very suspicious views on the distortion of intercompany transfer pricing. The Korean tax story have had a more suspicious view on the profitability of foreign invested firms engaging in significant intercompany transactions because the profitability itself may be controlled by the foreign affiliates, and then income they feel should have been allocated to the local entity, may be allocated to foreign affiliate by the distortion of intercompany pricing. And there are several other areas that NTS has been focusing on, and I will just say that one by one. The first one, they focus on the royalties for the use of intangible. And as you understand, the NTS has been traditionally focusing on the level of profitability for the local entity. But recently, they have been more thoroughly investigating the reasonableness of the royalties and raising questions on what the intangibles really are and what benefit the local entity will really get from the use of intangible. Let's move on to the next slide. And the second thing is they begin to request huge information to foreign affiliates. Recently, NTS has been requesting substantial TP information from foreign affiliates to evaluate the functions and the risks of the foreign affiliates in order to decide whether the test party is actually the local entity or the foreign affiliate. If the local entity fails to provide the requested information, then the NTS may impose administrative fines for non-compliance. For example, the NTS has been recently targeting sales support service transactions for various local entities, and they've been investigating very aggressively. And then they like to know whether the service activities constitute a permanent establishment of the foreign affiliate, and the services are actually auxiliary or preparatory in nature. In order to understand the true nature of intercompany business, the NTS requested abundant information from foreign HQ or other relevant foreign affiliates. And they've been also focusing on a recent change in TP policy for local entities as well. And for example, increase in the royalty rate from 1% to 3%, or new royalty payment, then the royalty payment doesn't exist in the past, or increases in the service fee payments, or new service payments, etc. And the NTS requesting local entity to demonstrate why the change makes sense to local entity commercially. And commerciality is important part that the taxpayer has to prepare and to prove the reasonableness of the change. And during the pandemic, various MNEs have changed their TP policies for local entities around the globe. If the entity fails to prove the commercial reason for the changes, then it will highly likely that NTS will make a relevant TP assessment. Let's move on to next slide. And in this, transfer pricing trends, there are several key takeaways. I think in the event of a TP audit, the foreign affiliates should be ready to provide the requested information to the local entities. If the taxpayers fails to comply with NTS request, an administrative fine may be imposed. And thus, taxpayers may wish to review in advance whether the information to be requested by the NTS is really available. The second thing is reasonableness of TP policy for intangible and change in TP policy. It should have been reviewed in advance. The NTS should understand the value and the benefit of the intangibles and change it in the TP policy. So supporting documents, evidences to prove the value and the benefit of intangibles and the commercial reasons for change should be maintained and shared with the local entities in Korea. Especially for sales support services, the roles of local entity should be limited to mere communications, simple supporting roles. And thus, it should be demonstrated the local entity has no authority to conclude contracts or to make a decision, very important decisions on pricing. And lastly, the service fees, supporting evidences should be maintained, to prove the services are actually provided and the local entity received a clear benefit from the services. That is the current TP audit trends that I wanted to share with you.
Okay. Now, our next question, and we'll just maybe briefly answer this one, if possible, in the interest of time, is have you noticed any recent changes in how TP audit assessments are being appealed? And this, of course, is MAP and APAs, and even would include the tribunal beyond that. So in the interest of time, maybe just a brief response to that. And again, Taijoon, do you want to say something briefly about this first? Okay,
I will just share my experiences on the MAP, and APAs. The recent trend is there has been a noticeable decrease in APA and MAP applications, and I believe that is why, because the APA pre-filing process has been very difficult to process. As you understand, before applying the formal APA application to NTS, the APA pre-filing team has to review first, and the APA pre-filing team under the APA division has been nowadays thoroughly reviewing information submitted by taxpayers, and thus, that the pre-filing process takes longer than that in the past. So taxpayers who would like to pursue the APA process before tax audit should understand the recent trend and then plan their timeline accordingly. And there's another thing that we also take into account, that is, if the APA team or competent authority of other countries are in a tax refund positions after or in the course of the mutual agreement procedure, including APA process, this will eventually reduce the tax revenue in their country during the pandemic. For these reasons, we have seen recently various cases where not 100% full compensating adjustment, partial compensating adjustments were made. So at this point, we believe it would be very difficult for taxpayers to obtain 100% compensating adjustment. And let's go to the next slide.
Maybe in the interest of time,
Okay.
I think thank you very much. That was a great response. And we've got these other materials in the booklet so people can refer to them, and also they have your contact information. I'd just like to pose the same question briefly to Commissioner Suh to see whether you have any additional comments.
Yeah, thank you for the question. As Taijoon just mentioned, it comes out that some MAP cases take too much time to conclude. And recently, depending on the complexity of the cases and the position of Korea and other countries, MAP sometimes result in incomplete elimination of double taxation. I think that's why companies which could have gone to MAP or APA in the past are now inclined a little more to appeals than before. Speaking of courts' approach to transfer pricing, Korean courts had the tendency to conclude TP cases based on the legalistic judgment, such as on whom is the burden of proof, and also had a tendency not to go deep into economic analysis. But recently, I have seen court cases which goes more deep into the economic analysis, and also it seems that courts are referring to OECD transfer pricing guidelines more often than before. Thank you.
Thank you. And that last comment is particularly helpful as we segue to our next question, which is addressed to Taehyung Kim. And this one is, what does the OECD's guidance on the transfer pricing implications of the COVID-19 pandemic generally discuss? And what are the implications as well as limitations of this guidance from a practical perspective? Taehyung?
Thank you. As many of the audiences are already aware, the OECD published the guidance on TP implications of the COVID-19 pandemic in December last year. As you can see on the slide, the guidance focuses on 4 main topics. I would like to discuss on what each topic is basically about and which area is somewhat vague that multinationals should be careful in applying the guidance. First, on the comparability analysis, the guidance emphasizes importance of analyzing and documenting both quantitative and qualitative COVID-19 effects. The existing OECD TP guidelines has already mentioned about outcome testing approach, use of multiple year data, and inclusion of loss-making comparables. So these are not totally new concepts, but the OECD's recent guidance recommends that these approaches can be especially useful for business years affected by COVID-19. The guidance, however, does not specify detailed analysis methods to be used in practice and also countermeasures for potential disputes between a taxpayer and a tax authority, or even between tax authorities when applying these approaches, such as inclusion of loss-making comparables. Second, on the losses and allocation of COVID-19 specific cost, I would say the guidance confirmed the definition of limited risk entities for TP analysis purpose, that they could incur losses and still be at arm's length. However, detailed examples on consideration of industry or company-specific factors to be used in cost allocation might have been more useful. I understand that the UN's Transfer Pricing Subcommittee has expressed its intention to work on sector-specific guidance for TP matters in the near future. So we can wait for the outcome of such work. Third, on government assistance programs, these should also be reviewed in relation to the economic impacts and local features with government assistance. But I think the guidance did not consider information asymmetry, that it would be difficult getting access to comparable status with government assistance. Lastly, on advanced pricing agreements, or simply APAs, the guidance provided recommendations on both existing APAs and APAs under negotiation. But it seems that the guidance did not consider high possibility of breach of critical assumptions due to COVID-19 for existing APAs, and also did not provide more practical negotiation methods between tax authorities for new or ongoing APA applications.
Thank you. Now we'll go in a little bit deeper into the guidelines, and what I'd like to do for this, the next questions two questions I'd like to lump together and address them both to Commissioner Jin-oog Suh of Kim and Chang. And the first one of those questions is, under a COVID-19 situation, the sales volume of a limited risk distributor diminishes dramatically. Can this distributor incur losses from a transfer pricing perspective? That's question one. And the next one is, when a contract manufacturer faces a capacity underutilization, how would the situation be dealt with from a transfer pricing perspective? So the first one, again, addresses limited risk distributors with diminishing sales volume, and the second, a contract manufacturer with capacity underutilization. So, Commissioner Suh?
Thank you, Jeremy. I'd like to answer the two questions based on the OECD transfer pricing guideline and OECD guidance on transfer pricing implications of the COVID-19. The first question is, as Jeremy just mentioned, can a limited risk distributor incur loss from the standpoint of transfer pricing? Let's just get into the transfer pricing guideline first. The OECD guideline says that the simple or low risk functions in particular are not expected to generate losses for a longer period of time. But depending on the circumstances, loss-making transactions can be comparables. Now, the paragraph 3.65 says the circumstances. It says that circumstances in which loss-making transactions enterprises should be excluded from the list of comparables include cases where losses do not reflect normal business conditions and where the losses incurred by third parties reflect a level of risks that is not comparable to the one assumed by the taxpayer in its controlled transactions. Conversely speaking, I think this sentence means that, well, losses reflect the normal business conditions, and where the losses incurred by third parties reflect a level of risks that is comparable to the test party, then the loss-making transaction or enterprise can become comparables. Based on this principle, now I'd like to speak specifically about the loss-making situation of a limited risk distributor based on the OECD guidance on the transfer pricing implications of the COVID-19. It says that where there is a significant decline in demand due to COVID-19, a limited risk distributor that assumes some marketplace risk may earn a loss associated with the playing of this risk. And then it goes to say that the TNMM or potentially the resale minus method might be used as the most appropriate method. And at this point, I'd like to say that the sales-based profit level indicator can be used when the limited distributor assumes some kind of market risk. And then if the comparables have a similar risk profile, and when it is in the loss-making situation, it can be comparable, become comparables. Back to the. So I'd like to make just one point here. So, which is that if the loss-making, the limited risk distributor do not almost assume the market risk. For example, when the barrier ratio is appropriate for this limited risk distributor, then the loss-making comparables may not be comparables for this kind of limited risk distributor. Secondly, I'd like to mention the capacity underutilization situation for contract manufacturer. So for this case, I'd like to introduce the OECD transfer pricing guideline first. Company B manufactures products for Company A, where capacity utilization risk have been identified as economically significant in this transaction, and Company A, not Company B, assumes these risks. And then the guideline explains in more detail about the characteristics of this contract manufacturer by analyzing the function, by doing functional analysis. It says that Company B built and equipped its plant to Company A's specification. The products are manufactured to the requirements and designs provided Company A, and that volume levels are determined by Company A. Company A also performs regular quality checks of the manufacturing process. And then the guideline delves more into the risk aspect of this case. And then it says, although Company B has incurred fixed costs, it has no ability to manage the risk associated with the recovery of these costs, since Company A determines volumes. What I'd like to mention here is that Company A and Company B would be in a situation to allocate this fixed cost between them. And we can now link this example with the cost allocation part of the OECD guidance on the transfer pricing implications of the COVID-19. The guidance says that the allocation of operating or exceptional costs would follow risk assumption and how third parties would treat such costs. And then the second, the underlying part says the specific case, but I'd like to just paraphrase this second part of the underlying part according to our example. And I can say that if the fixed cost directly relates to a particular risk, which is the capacity utilization risk, then the party assuming that risk, which is Company A, would typically bear the costs associated with that risk. Furthermore, the party initially incurring an exceptional cost may not be the party assuming the risks associated with to that cost at arm's length. The party means the Company B, and consequently such costs may need to be passed on to the parties that do assume such a risk, which is Company A. Okay, so that finishes my comment, but I'd like to just add just one comment for this case. Just back to the OECD guideline, sorry. the functional analysis part, it says company be built and equipped its plant to company A's specification. The extreme case of this is that company B cannot alter or change its products to flexibly to sell its product to a third party under capacity, under utilization situation. And this contract manufacturer may be the most restricted and the risk-free contract manufacturer of all. So this kind of contract manufacturer may be, for this case, company A's portion of the cost, of the fixed cost may be bigger than the general contract manufacturer. Yeah, that ends my comment. Thank you.
Thank you very much, Commissioner Suh. Next up, we're going to address a couple questions to Ron Parks. You're only going to get 2 questions rather than 3.
Okay.
In the interest of time. So the first question, and I'll lump these together, so hopefully you can note the 2. The first one is regarding hazard risk, and how should the interplay between the COVID-19 hazard risk and other economically significant risks be evaluated when considering risk assumption in a particular controlled transaction? So hazard risk. The second is, how may force majeure affect the allocation of losses derived from the COVID-19 pandemic? So those are the 2 questions I'd like you to take a stab at, Ron.
Thank you. Very good. So I had prepared 3 themes, but we will cut that back to 2. In answering these questions, I'm trying to tie a link together. We have a lot of very good guidance on how the Korean authorities are reacting in practice. What I'm trying to do is step back and really focus on the framework that the OECD guidance gives us. So my now 2 themes are first evolution and not revolution. And what I mean by that is, even though this is a very extraordinary circumstance, a global pandemic, and it's raised a lot of practical issues with how to prepare transfer pricing documentation, how to get comparables, et cetera, we still are using the tools. We still refer back to the OECD TPG from 2017, and I think that's very encouraging. If you look on the tomorrow's presentation, when they talk about Pillar 1 and Pillar 2, I view that more in terms of a revolutionary step, something that 10 years ago I wouldn't have expected to come out. My second theme is avoiding tunnel vision. We tend to really focus on our transaction locally that we're analyzing, the intercompany agreement that we're analyzing, very issue focused, and of course that's good and necessary. But again, if we look to the OECD guidance, it's partially their job, they tend to step back and they take a much broader view, dare I say a panoramic view of some of these issues. And I think that's very useful to putting in context the arguments that we may need to make on behalf of our clients in the future, getting through this very unique situation. With that upfront introduction, let's just jump in. The hazard risk versus other economically significant risk. I really boil this down to, in essence, a who question. And in my mind, it's who bears the risk. And again, I think avoiding that tunnel vision theme, we look that if you look to 1.34 and 1.35, very eloquently stated, and I've tried to paraphrase and boil this down, understanding the commercial and financial relations between the associated enterprises requires a broad-based understanding of the industry, indeed the group after the industry, and how risk is allocated. And then from there, once this is established, you do the entity level analysis of the controlled transaction for economically significant risks. Once that's all established, and it really should be well documented in your transfer pricing documentation, then you layer on how the COVID-19 hazard risk has impacted the controlled transaction in a broad sense. So from there, we take some examples. The COVID-19 pandemic, which constitutes a hazard risk, has led to some unusual outcomes, including product demand, operational risk, disruption of supply chains. I think that segues nicely into the force majeure issue that we'll have coming up, and the financial risk, of course, on borrowing cost and collections. The guidance goes into some detail, so time should be spent on how enterprises respond to the hazard risk, and it of course triggers the usual suspects, who are the strategies, what markets we're working in, the products and services, what are the key functions, of course, the assets used, risk assumed. And I think that going back to that framework, it supports the position that loss-making companies can be included in comparables because they meet the arm's length standard. So ideally, the analysis of hazard risk should look to the impact on the industry, the MNC group, and ultimately, what entity should bear the hazard risk. Moving from there to the impact of a force majeure. Again, there's a great deal of pragmatic experience on ground, and I've spoken to some Lee and Co. Colleagues that have expressed to me that, pretty clearly the language of the force majeure agreements says that it should be enacted, invoked. But the guidance takes a little bit different flavor on that, a little approach. They look at all the situations where you may not invoke force majeure. Perhaps these are the more interesting cases where they talk about what is the length of the disruption? What is the magnitude of the disruption? What if a similar company in a similar situation, because the length of the disruption wasn't that intense and the magnitude was not really there, wouldn't invoke force majeure? So, it's the less obvious arguments that the guidance takes us through. And I think it may be useful when building arguments in situations where the client has amended their agreement or through some other mechanisms economically had an equivalent result to what would have come to pass had a force majeure clause been invoked if the language wasn't there in the intercompany agreement. So I'll just quickly highlight, in the sense of time, events triggered the use of the clause could include prohibition activities by government body and the conduct of the parties, very emphasis there in the guidance. For example, Company G provides manufacturing services to Company H under a long-term manufacturing agreement, and the government mandates the closure of this facility. So in the guidance, they talk about, well, what is the length of that disruption and what is the actual magnitude? In essence, they make a point that, of course, the underlying agreement in its plain language should be the starting point for the transfer pricing analysis, but it should not be assumed that the pandemic will automatically allow force majeure clauses to be invoked. So I think there's a lot of good examples in the guidance. If you have a situation where you fear your client may be challenged on the allocation of losses from a force majeure clause, that you can look to these examples and the analysis that they give in the guidance. Thank you.
Good. Thank you, Ron. And now, as we take a step back from all of the OECD guidance and take a look at what Korea is doing to take items that appear in the guidelines and adopt them as law or policy. So for this question, what I'd like to do is ask Hyoung Kim if he'd answer, how does the Korean government plan to reflect or introduce the OECD's guidance, and are there any recommendations to further improve the Korean government's legislative action from a practical perspective?
Thank you. So based on the 2021 tax reform proposal published in July this year, the Korean government has reflected some areas mentioned on the OECD's guidance in the Adjustment of International Taxes Act. In details, with the objective of rationalization of TP taxation under special circumstances, inclusion of loss-making comparables and modified cost contribution arrangement would be permitted for certain conditions, such as economic downturn or force majeure events. I believe multinationals in Korea whose businesses have been significantly impacted by COVID-19 would be somewhat relieved with these new provisions. However, it seems that there might be some improvements with the Korean government's legislative or administrative measures to be considered based on the 4 topics discussed on the OECD's guidance. For instance, the Korean government may take an administrative measure on the extension of TP-related documentation submission due date for taxpayers to have sufficient time reviewing and analyzing contemporaneous data. And also from a broader perspective, a legislative provision on the treatment of exceptional and extraordinary cost might be useful. Thank you.
Good. And we have one last question. We've got a few minutes left. And this is again addressed to you, Hyoung Kim, about how have other countries, other foreign countries, reflected or introduced practical transfer pricing measures that deal with the COVID-19 pandemic.
So based on the OECD's research, many countries have actively provided fiscal and tax policies to help taxpayers affected by COVID-19. In particular, countries like Germany, France, and India have explicitly extended due dates for filing TP-related documentation to ease taxpayers' compliance burden. For today, I would like to introduce advanced countries' policies such as Singapore and Australia, which actually provided practical TP measures in relation to COVID-19 even before the OECD published its guidance. So first, Australia provided explanation under the title COVID-19 Economic Impacts on Transfer Pricing Arrangements in July last year. So the overall information is very similar to the OECD's guidance, especially on comparability analysis and treatment of APAs. Next, Singapore provided COVID-19 support measures and tax guidance in September last year. So in a Q&A format, Singapore's guidance is also generally consistent with the OECD guidance on the 4 major topics that I discussed today. Specifically, Singapore's guidance is very useful and rather practical, that it provides very detailed examples on multiple year testing of the related party transactions, as well as treatment of government assistance used for comparability analysis. Lastly, long before the COVID-19 pandemic, Canada published a memorandum on the consideration of government assistance, impact on transfer pricing. And I think it can be also used as a reference under the current situation. And that's it for my panel discussion today. Thank you very much.
Thank you very much, Hyoung. Well, that's our questions for today, and we'd like to thank our panelists for their preparation and responses and comments. And also thanks to all of you for making it through sessions 1, 2, and 3 today. We hope that you enjoy session 4 and the rest of your day. Thank you.